Interest rates, too low for their own good? Many people are beginning to wonder if central banks have squandered their chance to bring inflation under control. It's a huge question, especially for global bond markets. Some question whether central banks are either ahead or behind the curve in battling inflation, or whether this week's U.S. Federal Reserve change to a tightening tendency and the Bank of England's first salvo of higher rates struck the sweet spot in terms of timing. Global inflation is currently volatile, making it difficult for central banks to keep track of it. However, the truth is central banks seem to be attempting to normalize interest rates to have stronger monetary traction in the future, rather than focusing on production, inflation, or jobs. Some doubt the Fed's stance, while others say it is doing the right thing by indicating a return to a more typical range for interest rates of 3% to 4%, with the possibility of even higher rates in the coming years. Years of near-zero interest rates, limitless bond buybacks, and money printing as part of the quantitative easing program both in the aftermath of the 2008 financial crisis and during the COVID-19 crisis have left some with a strong impression that central banks have thrown caution to the wind, and that monetary constraint is long overdue. This is especially true when governments tasked with averting a deeper global recession have gone into overdrive with fiscal expansion. Some argue that policy need be tightened. The Fed appears to believe that this is the case. Finally, the Fed has laid the stage for 325 basis point interest rate hikes in 2022, citing consumer price inflation of 6.8% in November and the prospect of the headline rate rising considerably higher in the following months. However, if inflation expectations start to rise unexpectedly, the script might soon shift. With real U.S. interest rates at their lowest point in nearly 70 years, the Fed may have no choice but to adopt precautionary measures. The essential question is how far these plans must be extended over the medium term for the Fed to have better monetary traction the next time big monetary stimulus is required. The effective U.S. Fed funds rate fell from 6.5% to 1% during the dot-com stock market crash of 2000, and from 5.26% to near zero during the global financial crisis of 2008, both of which provided considerable boosts to recovery. However, by the time the COVID-19 problem erupted in 2019, there was little room for additional adjustment, as the federal funds rate dipped from 2.4% to zero. It's no surprise that the Fed was left with no choice but to increase debt purchases once more, while the U.S. government was forced to engage with substantial fiscal stimulus measures to prevent the economy from collapsing much more in 2020. The Fed's latest projections for future U.S. interest rates remain unchanged from September's meeting, with the median midpoint for Fed funds at 2.5% by the end of 2024. Some argue that given the current level of U.S. inflation, the strong recovery, and the labor market's near full employment, this is still too lenient. Some would prefer a return to interest rates closer to 5%. It's impossible to say what will trigger the next round of quantitative easing and the demand for lower interest rates. Despite tremendous policy stimulus and significantly improved global governance norms, dangers to the global economy remain high. Global financial stability is precarious, and central banks around the world must be prepared for potential shocks. Perhaps higher interest rates now are required for our own protection in the future. Please like and subscribe if you enjoyed this video. It helps support our distribution efforts.